Hello, this is Bob Steele. In this video we will be talking about capital gains and losses. The objectives will be, at the end of this, we will be able to describe assets as ordinary assets, sections 1221, capital assets, and business assets, section 1231. Explain the recognition of gains and losses on the sale of ordinary assets. Define short-term and long-term gains and explain the tax rules related to each. Explain the rules to recognize gains and losses on a sale of a business asset. So first, let's take a look at the tax equation. If we're taking a look at the equation for the 1040, the individual tax equation, the capital gains will be included in gross income. Now, just like with business property, this can be a little bit deceiving because we will be calculating the capital gains on a separate sheet. For investment property, that will be a Schedule D, and then we'll be transferring that number onto the gross income of the first page of the equation. So when we have properties such as if we were selling stocks or bonds, then we would have the cost as well as the sales price. The difference between those two would then be the amount that would then transfer over to the first page of the 1040. So remember that we do have those two components involved. We will be doing that on a separate schedule. We'll then be taking that net amount and bringing it over to the front page of the accounting equation, or the 1040. Adjusted basis. So one of the first concepts we want to take a look at is the adjusted basis, and that's the cost of an asset less any accumulated depreciation. So if we're talking about stocks and bonds, which is going to be the most common kind of individual type of thing that we will include on many tax returns, what we're saying is that we sold the stock for some point at some value, and of course we bought the stock at some point in the past for some value, and the gain is the increase. So if we bought it for 1,000, it went up to 2,000. The difference, the 1,000 increase, would be the amount that could be taxable, subject to taxation. Now, if we're talking about something other than stocks or bonds, we're talking about a depreciable asset such as a building, then if we bought it for 100,000 and it depreciated down, the book value is what we're going to say is the adjusted basis. So the adjusted basis is the term for kind of the cost of the item that we are selling in order to calculate the gain. And we can think about that as the after depreciation for depreciable assets. Now, when we think about basis, think about it from a tax standpoint. What we really want is the basis to be as high as possible when we sell the item for taxes, because that would lower the amount of gain that we report, and the lower the gain that we report would be less taxes. So when we report the sale of assets, from a tax standpoint, we're hoping for a higher basis amount. And due to the fact that there are different tax rates for capital gains and the progressive tax structure and some different tax implications for things such as gifting, we have some interesting kind of effects that happen that we need to be aware of. For example, if we bought stocks for $100 and 10 years later they're $1,000 and we wanted to gift those stocks to, say, our children, then from a tax standpoint, the IRS doesn't want you to be able to give the gift to your children and have them get it at the higher basis or fair market value of $1,000, because then they can go right around and sell it for that $1,000 and not recognize that gain from the sale. So that would clearly be a loophole, I guess we can call it, in the tax treatment. It doesn't seem fair that that would be the case. So that in that case, if we gift the item, then if the basis to the donor is less than the fair market value, we have to keep it at the gifter's basis. Therefore, as long as the person who receives the stocks doesn't sell them, they're okay. But when they do sell them, they have to recognize the entire gain. They don't get to not recognize the gain that was there when it was held by the previous person. And if on the other hand the fair market value is less than the basis of the gifter, then we would have to take the fair market value. So note that in that case we don't really want to gift something that went down in value, because the basis we'd have to take it at the fair market value and we'd lose out on the tax planning. So form 4797, sales of business property. So this form is used to report gains or losses from sale of business property. Business property will be treated slightly different than individual or personal property. Investment property will be on the Schedule D, so capital gains and losses will be on the Schedule D. So if we had the sale of stocks and bonds, it would be on a Schedule D. Used to report any gains or losses from the sale of property held for investment. Sale of capital assets must be held for more than 1 year for preferential tax treatment. So capital assets are generally going to have a preferential tax treatment if they're held for more than 1 year. So remember, when we're talking about taxes, we have a progressive tax scale when we're talking about federal income tax. Then separate from that, we generally have a lower preferential tax rate for capital gains. And in order to qualify for that rate, we have to have it for more than 1 year. There's a couple justifications for this that people argue that we would have this lower rate. And those are going to be that, one, we want to stimulate investment in companies. If we're talking about lower rates for things like stocks, we want people to have an incentive to have a competitive rates in the U.S. to compete in those. And two, they would say that if, for example, we held on to an asset for a long period of time, say like 10 years, and it went up in value to, and when we sold it, the capital gain would be $40,000 after holding on to it for 10 years, that recognition of the $40,000 may push us up into a higher tax bracket. And the argument could be that it wouldn't be fair for us to be put into the higher progressive tax rates when we sold it at one time, when in actuality we earned the revenue over that time period. And another argument is that we don't want to basically disincentivize people from taking action that they otherwise would take because of taxes. So, for example, we don't want businesses to not sell something because of the tax treatment. It would be unwise for us to influence the decisions of businesses in that way. And then, of course, on the other side, on the argument of not having a separate tax rate or a lower capital gains rate, would be that it's somewhat complicated, and it leads to funny things happening when we have a lot of different rates when we talk about planning. It also, if we're talking about stocks and bonds, we're talking that most people that sell stocks and bonds may be on the higher up end, so the tax benefit might be benefiting more higher income individuals than lower income individuals. So, but in any case, that is the structure that we have now. So we'll take a look at the implications of that as we go through. So non-business capital loss limits. If we're talking about non-business capital loss, we're gonna net out the gains and losses if we sold and we had a net loss. So, for example, if we sold something for $10,000 and we bought it for $15,000, the basis was $15,000, we would have a loss. Now, whenever we have a loss, we have to look at the IRS and say that they're going to be skeptical of a loss, because when we have a loss, then we're going to take that loss, put it on the front page of the 1040, and lower our normal business income. And when we do that, then of course our taxes will be lower. Therefore, the IRS will limit the losses on non-business capital losses to $3,000 a year. So in that case, we would only get 3 of the 5, but we do get to carry over the remaining 2. Also note that the losses are going to be against our ordinary income. Therefore, the loss is at basically preferential tax treatments, because our ordinary income could be something closer to 30%, and therefore, if it was a gain, we would be taxed at a lower rate. The loss is getting the deduction in taxes at the higher ordinary income rate, but it's limited to $3,000 a year in the case of non-business capital loss. So we also have an idea of a recapture principle. I want to give you the general concept of a recapture principle. Once again, it has to do with the tax rates and the progressive tax structure and the differences in the taxes for capital gains taxes. And the concept would be this, that there's some things that accelerate the depreciation. So those things being that the normal maker's depreciation, the depreciation that's often used for taxes, is basically a form of double declining balance, meaning that we depreciate more in the front end than in the tail end. We also, for economic reasons, to try to stimulate the economy, often have incentives to depreciate more, such as a 179 deduction. Therefore, it's very possible for us to depreciate more than the value of the asset has gone down. So if we then sell an asset, if we depreciate it more than the asset has gone down in value, we sell it at a gain, then if we had no recapture principle, that amount of depreciation that we wrote off, we got to write off at the preferred higher ordinary income rates. So we got a benefit in the deduction at the higher rates. But when we sold it, and we sold it for more than the book value, meaning we sold it for more than the amount that we wrote off for, then we got the deduction for writing it off. And when we had to include the gain later, we had to include the gain at the lower tax capital gains rates. And the IRS doesn't want that to happen, of course, because that could lead towards bad tax planning because of the differences in the rates. We don't want to incentivize people to buy equipment, take an accelerated depreciation to lower the taxes, and then sell it a year later and only have to record the lower capital gains rates at the other side. So if for that reason, if we have a depreciable asset, such as a building or something like that, and it went down in value and we sell it for more than the book value, we're often going to have to basically recognize the amount of depreciation that we wrote off up to the point of the sales price. Basis section 1231 gain and losses. So net 1231 gains receive preferential tax treatment, and net 1231 losses are treated as ordinary losses, not subject to deductibility limit provisions of $3,000 per year. So this form of business asset, and we want to note that it has basically the best of both worlds. So section 1231 assets have net 1231 gains receive preferential tax treatment. So when we have the gain on this type of sale of assets, then it does get the lower gain treatment, the lower rates. But when we sell it and we get a loss, we get to take the loss at the normal ordinary income tax rates, and we don't have the 3,000 limitation. So that's a big benefit. So that's a quick recap of some of the concepts that are going to be involved in the calculations of capital gains. So at this point, we are now able to define assets as ordinary assets, section 1221, capital assets and business assets, section 1231, explain the recognition of gains and losses on the sale of ordinary assets, define short-term and long-term gains, explain the tax rules related to each, and explain the rules for recognized gains and losses on the sale of business assets. Thanks.